What if I told you that investing just $500 a month, not winning the lottery, not starting a billion-dollar business, not inheriting money, could quietly turn you into a millionaire? No hype, no shortcuts, just math, time, and discipline. Most people underestimate small monthly investments because they think wealth is built in dramatic moments. It isn't. Wealth is built quietly, predictably, while life is happening in the background. Today, we're going to break down exactly what happens when you invest $500 every single month, year by year, decade by decade, and why the real transformation isn't just financial, but psychological. Stay until the end because the final section reveals why most people who could do this never actually do. 1. Why $500 a month is more powerful than it looks. At first glance, $500 doesn't seem life-changing. It won't buy luxury cars, it won't make headlines, it won't impress anyone on social media. But $500 has something most people ignore: consistency. When money shows up regularly, it unlocks a force far stronger than intelligence or luck: compounding. Most people wait for a big opportunity. Wealthy people focus on repeatable actions. $500 a month is not about the amount, it's about the habit. 2. The assumptions we'll use. To keep this realistic and conservative, let's set clear assumptions. You invest $500 every month. You invest in broad, diversified assets. You earn an average annual return of 7%. You reinvest all returns. You stay consistent through ups and downs. This is not an aggressive scenario. This is historically reasonable. Now let's see what actually happens. 3. Year 1 to 5, the most discouraging phase. In the first few years, investing feels underwhelming. You're putting in real money, but the results feel small. After 1 year, you've invested $6,000. Your balance is slightly higher, but not exciting. After 5 years, you've invested $30,000. Your portfolio may be around $35,000 to $40,000. This is where most people quit. Why? Because effort feels bigger than reward. But here's the truth. In the early years, you are the engine. Your money hasn't started working hard yet. This phase tests patience, not strategy. 4. What's actually happening under the surface? Even though growth feels slow, something critical is happening. Your money is learning how to grow. Every contribution buys future returns. Every reinvestment increases the base. Compounding doesn't explode early. It layers quietly. Think of it like planting trees. The first years look empty. Roots grow underground long before branches appear. Most people quit before seeing proof. 5. Year 10, the first "wait a minute" moment. After 10 years, you've invested $60,000. Your portfolio may be worth around $85,000 to $95,000. Now something changes. Your money starts earning almost as much as your contributions. Returns begin to matter. You still won't feel rich, but you'll feel momentum. This is the point where discipline starts paying interest. 6. Year 20. Compounding takes over. After 20 years, you've invested $120,000. Your portfolio may be worth $250,000 to $300,000. Here's the shock. Most of that money did not come from your contributions. It came from growth. Your portfolio now earns more in a year than you invest in several months. This is the moment when time replaces effort and assets replace labor. You are no longer doing the heavy lifting. Your money is. 3. Year 30, the $1 million effect. After 30 years, you've invested $180,000. Your portfolio may be worth $600,000 to $750,000. Notice something important. You didn't triple your effort. You didn't triple your intelligence. You simply stayed consistent. At this stage, your annual growth may exceed $40,000 to $50,000 without adding more money. This is where wealth starts feeling inevitable. 8. Year 40, when time becomes unfair. After 40 years, you've invested $240,000. Your portfolio may exceed $1.2 million. Let that sink in. Less than $250,000 invested, over $1 million accumulated. This is the power of compounding, not dramatic, but relentless. The last decade contributes more than the first 3 combined. Time doesn't reward urgency, it rewards endurance. 9. Why market crashes help more than they hurt. Most people fear market downturns. Long-term investors quietly benefit from them. Why? Because $500 buys more assets when prices fall. This is called dollar-cost averaging. Volatility becomes an ally, not an enemy. Crashes only hurt those who stop. For consistent investors, they accelerate growth. 10. The real risk is not investing. The biggest danger isn't losing money in markets. It's inflation, inactivity, and delay. Money sitting still slowly loses value. Doing nothing feels safe, but it's quietly destructive. Time punishes hesitation. 11. Why most people never see these results. Here's the uncomfortable truth. Most people can invest $500 a month, but choose not to. They upgrade lifestyles, chase short-term comfort, underestimate the future. They trade long-term freedom for short-term convenience. Wealth isn't built by those who earn the most, but by those who delay gratification the longest. 12. The psychological transformation. As investments grow, something else changes. Your mindset. You think longer term, calmer, more strategically. Money stops being urgent and becomes intentional. This psychological shift is often more valuable than the money itself. 13. The simple framework that works. Here's the formula. 1. Earn income. 2. Automate $500 monthly investments. 3. Diversify broadly. 4. Ignore noise. 5. Stay consistent. No brilliance required, just discipline. Closing. $500 a month won't change your life today, but it will change who you are in the future. The question isn't whether compounding works. The question is, will you give it time? Subscribe to the Wealth Code, where small actions build massive outcomes. You, rich.